I'm here at the Morningstar Investment Conference with Jacob Mitchell from Antipodes Partners. Now, Jacob, you're talking about global equities and some of the opportunities that are available for investors in the current market. Can you just talk us through what are some of the areas that you're sort of most excited about at the moment?
There's probably a range of opportunities. I mean, we tend to look for areas of neglect, where the market may be being relatively irrational in terms of good companies that have been impacted by changes. I think in technology, we're moving into a world of 5G. Telco companies are starting to roll that out. Now, that's a technology that is dominated by one company, which is Qualcomm. And it's an example of, we call it the cluster of opportunity we call connectivity. So companies that are going to facilitate this rollout around the world. And that's a very high quality company because it owns a lot of the intellectual patents that underwrite that technology. And it's cheap because the market has been concerned, it's having a fight with the world's biggest company, Apple. And Apple has to pay Qualcomm a few dollars for every handset that it sells in order to get access to these patents. So we think that will be resolved because the rules around this are fairly straightforward. Yes, Apple's going to flex its muscles, but ultimately has to come to the table. Beyond technology, I think if you look in an area like natural gas, oil and natural gas has been a neglected part of the market until recently, with oil prices moving up. As oil prices move up, it drives a lot of natural gas is traded relative to oil, except in the US, where gas production, there's been excess production. So LNG prices globally are moving up towards $10, but natural gas in the US is around $3. We believe that gap will have to close, and China needs to import a lot of natural gas to replace its heavily polluting coal-burning power generation.
So there's some areas that you're pretty bullish on. What about areas where you may have unwound your positions in more recent times?
That's a good question. I think what we've really tried to avoid in our portfolios are companies that could be characterized, regardless of the sector, as low-quality growth stocks. I think a good example, if you look at in software, you've got the emergence of very strong platforms like Microsoft Azure or Office, like Google Cloud, Amazon Web Services. Those platforms are increasingly adding capability. They don't want to just be dumb infrastructure. They want to provide high margin applications. As that happens, there's very narrow software companies that are at risk of losing their business. I think an example of one such company is a company that does video conferencing subscription. They're the sorts of businesses you need to avoid. Narrow businesses that are going to be potentially disrupted, or companies like Tesla that are just low quality growth. There's a lot of competition for Tesla. It's not a great way to get exposure to EVs. There's much more lower risk ways you can get exposure to that longer term trend.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.